this is going to be fun. We're going to have a fun day. And you've got any questions, just put it in the chat and we're going to be trying to answer that for us. So I have my guest on here, Rakhee Dhingra. Some people call her Rocky, but I don't know her from Rocky. I go Rakhee. What do you want to be called today?
Rakhee is fine.
Let's stick with that.
And thank you, Daryl, for having me today.
Right. So she's from Mortgage Savvy. She did To Your Real Success. Her and Nicole were sponsors with us there. So, you know, they bring a lot of knowledge and a lot of skill. The one thing I love about Rakhee is she's very educated and really on top of what's going on in the marketplace. So she's going to be able to answer a lot of questions. I'm going to ask her a bunch of questions. You got questions, you can put it in the chat. I'll be talking about what's going on in the real estate, because what two topics are on the top of everybody's mind every single day, right? Where's the real estate market going? What's the mortgage rates doing to the real estate market? So we're going to have a lot of fun. We're going to have hopefully a lot of participation. And, you know, one thing is that, you know, I've had 34 years of experience into this business. And, you know, if you listen to all the social media and all the doomsayers, you know, the world is going to fold up and we're all going to collapse. Well, I'm not one of those people that are going to tell you that. That's the furthest thing from my mind. You know, as the market changed, the market has changed dramatically. As we know that it's pretty much down 47% on sales, and in price, it's also come down. So, you know, the problem was that interest rates were too low. There was not enough supply, and it just escalated the prices to go skyrocket. So, you know, in the last few years, the market went up too fast, too quick. And now it, you know, I go back and I'll tell you about years and about the growth of what they were. So that created a lot of problems. So shortage of homes. So now they raised the interest rates 8 times over the last, you know, 10 months, 11 months. And it's had an effect, but not as much effect as the government would have liked, because the problem is there's not enough inventory out there. The inventory is very, very low. So the buyers that are looking still have to pay a fair amount of money to buy a house. So where are they going with the mortgage rates now? Because, you know, you think back 1 year from today, you know, we're on April 4th. We go back to April 4th. What were the rates like then?
So approximately a year ago, rates were hovering around that 3%, right? We were seeing rates around just over the 3% range. Where are rates headed now? We've seen rates on the decline. So any clients that have, you know, been engaging with a mortgage broker or a specialist or their bank have seen a tremendous sort of difference in where rates are sitting effective today. We saw what happened south of the border with Silicon Valley Bank, which impacted our bond market. And as a result, we're seeing rates hover around the 4.5%. And a few weeks ago, they were closer to that 5.6, hovering very close to that 6% rate. So we've definitely seen a decline in mortgage rates on the fixed side, that is.
So the 5-year fixed mortgage rates have come down.
They
right?
have, absolutely.
So where were they at, say, a month ago, and where are they today?
A month ago, we were seeing rates at around 5.6%. And today, on an insured mortgage purchase, on a 5% term, you're looking at a rate closer to 4.79. So that's almost a percentage change.
So let's say I had roughly an $800,000 mortgage. What would be,
The incremental change is approximately $50 per 100,000.
So for every 100,000, I'm saving $50.
Correct.
So the good point about that is, if you know, rates have come down on the long term, not the short term yet.
Correct.
Right?
Correct.
So, you know, do you believe rates are still going to come down further this year?
Absolutely.
Right?
Absolutely.
So it's a catch-22. You can get a cheaper rate if you take a longer term. So then you're guaranteed that will be your rate for 5 years. But if you probably wait 4, 6, 7, 8 months and be on a variable, you'll probably even go lower.
And that's where it comes down to the numbers. I think it's so important. And I love sort of the segue into this conversation where Daryl has really provided us with facts and real data. Mortgages have become the new COVID news, and it's so hard to decipher reality from what is true. And I think the information that Daryl has shared is real. There is a supply shortage. Canadians want to own their homes. That is a fact. And I think it's important to lead with that. Now, on the mortgage side of things, if you are in a variable rate product, and let's be honest, for the last 35 years, the variable rate product has been the interest saving solution. So we're in a time of uncertainty. This is confusing.
It is confusing. That's why we're here today.
Exactly.
To try to get rid of some of that confusion.
But the fixed rates are sitting lower. So if you are currently paying, let's say, a 5.8% rate on a variable rate product, and you're sitting there not sure what you should be doing because you've been so accustomed to being in that variable rate product as being the solution to save you interest and helping you pay your mortgage off that much faster, speak to an expert, because maybe a 2 or 3-year term will give you that degree of stability at a lower rate. Chances are your interest rate will be about a percentage to a percentage point 0.25 lower right away. Maybe we keep your payments where they currently are and work on a strategy to give you stability, a lower rate, and an exit strategy for 2 to 3 years where, rates will have come down, hopefully, and we're in a very different environment. And maybe then the variable rate offers you that solution and that sort of flexibility that you're looking for. So again, ensure that you're getting the facts that you need and basing it on your specific set of circumstances to make sure that you're doing what's best for you.
So if we look at the overall picture,
you go back for a year ago. So I've got historic statistics for the Toronto Real Estate Board. I don't know if I'll be able to see it here, but I'll go back as far as 1977. Okay. In 1970, this is Toronto GTA statistics. In 1977, there was 20,512 sales on the Toronto Real Estate Board. The average price was 64,559. Okay. Now you go back to interest rates back then, they were probably running somewhere about 15 or 16%, right? But that was on a $64,000 house price. So then let's go back now to, we'll go back to the year 2000. So in year 2000, there was 58,343 sales for an average price of 243. So the prices went up about 4 times, and the sales amount went up 2.5 times from 1977 to 2000, right? So, real estate is a long-term investment. You can't see, investors is a totally different animal, but for probably 80% of the people that are buying a home as their largest investment, they should look at least a 5-year term. Because if you look at a 5-year term, chances are you're not going to lose. You look at a 10-year term, you're guaranteed not to lose. So we just looked at, 13 years there, that 2.5 times more sales, 4 times the price. So if you had been renting in that period of time, you would have spent, the rents were a lot cheaper then, but now you've built up your equity from 64,559 to 243. So now let's go to 2007, where the market was pretty hot then. So we look at the amount of sales then, and there was 93,193 sales. So you go back 1977, 20,512, 2007, 93,193. Now we look at the price. The price in 2007 was an average price of 376, 236. So you think if you rented from 1977 to 2007, you would have paid out thousands and thousands and thousands and thousands of dollars, had no equity, and then now you would have had, 376. You would have bought for 64,000. So you would have probably bought for $300,000 profit. Now let's keep continuing to go in this growth, because the mortgage rates in 2007, you remember what they were then?
2007? I wouldn't be able to guess off the top.
Okay. So let's just go now to 2017,
Mhm.
right? 2017, 92,340 sales. Not much different from 2007. Because 2007 was a record-breaking year that
Mhm.
year. It was one of the best years in real estate history. So now we go to 2017. Their average is 822,510. Wow. So back to 1977, 64,000. Now we go to basically 2020, before it started, we had 95,066. So not much greater than 217.
And if I may, in 2018, rates were hovering around the 3.89, very close to that 4% mark, not far off from where we're sitting today.
Bingo, right? So, and look at what happened then in 19. It went 87,747. Price average 819. Now look at from here, 2020, 95,056. Not much different than 2007. Almost the same amount of sales, right? So then you look at the price, that was 929,636. What would have been in 2020? What were your rates then?
Oh, 2020 is the year of free money.
Free money, right?
Free money. We had, rates as low on the variable side at 0.99. How many of us remember that? Fixed rates hovering at 1.5%.
So look at how many sales happened with free money. So in 2021 was the record-breaking year in the Toronto Real Estate Board and GTA, all-time high ever. 121,712 sales. So it surpassed our highest best. In 2016, we had 113,000 sales. So we went to 121 with the super low interest rates. And look at where the prices went to. 1,095,475. Like, boom, right? So when people are saying they're sitting on the sidelines and waiting, well, guess what? You know, when you go on a cruise, on a boat cruise, and the boat sails at 5 p.m. and it doesn't sail at 5:01, it sails at 5 p.m. So you're either on that boat or you're on that dock. And I've been on a number of cruises, and we've all been out in the bay, and we're all waving at these people, and they're going like this. We missed the boat. Why did we miss the boat? Because they were late getting to the boat, right? So it's no difference then. Is the market going to change and increase?
Absolutely, it already is.
Right?
We're seeing it now.
So interest rates are probably going to come down.
Correct.
Right? So if you're a buyer, now is the best time to buy your house, because as we know, we're going into spring market, and we see what happened in January, February. I was hoping today we would have had the market statistics out there. Unfortunately, Trev didn't get them out to me today. So tomorrow they'll be, so it's one day late for us to announce that. But I'm presuming it will probably be between 40 to 45% last March. Okay. But it's up over January and February. And prices have definitely inched up higher again already. So if you're sitting on those sidelines, you're missing that boat. And you know, when you miss that boat, they got to catch a little plane to go to the next island if they want to catch up with the cruise again, because chances are all their stuff is on that boat. So,
absolutely.
So, and we go to 2022. So you now watch in, we went from 121,000 sales to 2022 with 75,082 sales. So sales have dropped off 47%. That's a statistic. That's reality. Now the average price still was 1,189,917. And then the last month that we had for February statistics were an average of 1,095,000. So down from that number by roughly $100,000 on average. So yeah, did prices come down a bit? Absolutely. Did interest rates go up a bit?
Slightly.
Slightly. Now realize your principal, when the market was this hot, so let's say you were buying a place or $1.5 million. So your principal amount is based on 1.5 million. If you're buying that same property today, it's probably closer to 1.3. So you've lost $200,000 that you would need less financing.
Correct.
So what would be the difference from 1.5 to 1.3, say in the last year?
So in terms of mortgage savings,
Yes.
it would be approximately, I'd say just about 11 to 1200 a month.
They would save on
Yes, on the mortgage payment.
So you'd actually save. So see, they've got people thinking that interest rates are too high. You can't afford it. You can't afford not to buy because your principal residence is what, you know, in the old days, like my parents lived in their house for 39 years. If they had to move 4 times in that duration, they would have had at least $1 million more net, probably more, but $1 million more for their retirement package. You know, the old school that they used to teach us is buy your house, live there for 30 years and let it accumulate wealth. But now what I would teach somebody is to sell every 5 to 6 years, get your wealth and move up to something bigger.
Right? Get into your long-term home as quickly as you can. Absolutely. And I think it's about running the numbers. I think there's so much information out there. It's hard to understand what you're supposed to be listening to and what you're supposed to be leaning on as credible information. And I think you base it in facts. You look at a property in terms of what properties in a specific area were listed for in 2020 and 2021, and you look at that differential, you look at the change in the market, you assess what you would have been paying as a mortgage payment back in 2020 or 2021, and you look at the numbers today. I think you'll be surprised that the numbers don't look that much different.
See, everybody just watched the interest rates, but they didn't watch the prices. So some people were sitting on the sidelines saying, oh, when are we going to hit bottom? When are we going to hit bottom? The funny thing is, like, stocks go up and down very dramatically in a day, boom, 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 and they can bounce back. But sometimes stocks are not real. Land or a house or a condo or anything like that is real.
See, touch, feel.
Exactly, right? They only make so much of it. You got a water over there.
Thank you.
Right. So I always believed in what I know best, and that's real estate. You know, should you invest in stocks? Get a good stockbroker, and some people can do it on their own. But, you know, one thing I do know, if you're going to hold your real estate, there is no better investment for you. And it doesn't matter what the interest rates are. I started the business as 21%. But, you know, back then, the prices were so low, it didn't really matter.
And I think when we speak with conviction, we do so from a place of actually going out and purchasing investment properties. I know that the life I live today is very contingent on the fact that I made smart real estate investment decisions. I'm very much about also being diversified, but when we have conversations with family and friends, how many of those conversations with respect to wealth building will defer immediately to smart real estate purchase decisions? Many.
Right.
So we use that as sort of a basis for having security and knowing that a long-term focus with real estate will pay off in the long run. And I say that with conviction.
So if someone asked me today, is it a good time to buy? Because I get asked this question all the time. I would tell you right now, I would rate this a 10. I don't think there's a better time for a buyer to buy, because the better time was back in December and January and February. That's past. But I believe that the market is going to shift a little bit higher. Rates probably are going to come down a bit in future.
Absolutely. And
Right.
this is where every single first-time home buyer that felt priced out of the market in 2020 and 2021 should be revisiting their numbers and taking advantage of the market today. And I would agree, December, January, and February were the time, but it's not too late to go through the exercise of educating yourself on your options and then base it on facts. Have your realtor provide you with data, track or what are properties selling for. And I think you'd be surprised, things are selling above the list price again.
Lots of them in multiple offer situations. And that's because of lack of inventory. So you would have to get a good realtor that knows the area that you're moving to. That's the number one thing, is look for a good qualified realtor that knows the area that you want to go to. Then look for a good qualified mortgage person that you can't do both without doing both. the first thing you got to know is how much you can afford. Because if you don't know how much you can afford, you're just running around with your head cut off.
For sure. And it's like it's like going shopping without knowing what you have available on your credit card, right? It's the same analogy, right? You need to have clarity on what you can qualify for. But I think the important conversation that we've all learned over the last few years, understanding your affordability. Do you have a child that that is going to require, childcare costs? That's not something you're visibly going to be able to see on your credit bureau. It's important to have a strategic financial coach and advisor that you can lean on for support to ensure. I often say, I want you to like me after you've moved in. I want you to be able to enjoy a life by design. We want to travel. There's other life goals as well, and ensure that you're working with somebody that understands your life goals and supports you in creating a structure, helps you get qualified and gives you an assessment so that you feel empowered to take that next step.
Guys, the most important step is, even whether you own a house, that you should talk to the mortgage broker first. Without the bank, the mortgage broker, whatever that is, but you need to know, and then what your lifestyle, what you want it to look at. Listen, when I bought my first house, I was 21 years of age. I think it was $90,000 or $96,000, and I didn't have a lot of money back then, and probably have less now, but that's another thing. Anyway, so I worked very hard because it was a 9-month close, and I bought a new house. So I saved up as much money as I could for the deposit that I have a smaller mortgage. So now the house prices are a lot more money than they were back then. So, if you already own a house, you already have equity. So then you have to find out off a good qualified agent what your house is really worth. Not because most sellers want to hear what they want to hear. Guys, that's not what's going to get you to your new house. You need to find out what your house is really worth. So get a real price, what it will sell for in today's market, not what it would have sold 2 years ago, because some people are still living in that 2-year dream. Like I just talked to a guy that I've known for a long time, and his neighbors sold for 1.7, 1.75, 1.65. I went and seen him in February, and his granddaughter's going to move out. He wants me in his house. So I just talked to him half an hour before I get on this call. He says to me, "Yep, I want 2.7 million in my pocket." First he said 2.5, and then he said 2.7. I said, "So really, what are you looking for? 2.5 or 2.7?" He said, "No, 2.7 in my pocket." I said, "Well, all your neighbors have only sold for between 1.65 and 1.75. Okay, so if you're all equal, you're somewhere around there." And that was in February, so maybe it's increased a bit. But I said, "You're not going to receive that money." So that's just him. If I don't get that money, I'm not selling. My house is better than the next house. Listen, a bank, right? If I came to you, so there's 3 sales right there, and it's a sort of state subdivision, the bank wouldn't appraise it at 2.7.
No.
Right?
No.
So even if I could sell it for that much, she can't get the financing for the buyer.
An appraisal is based on data within a 90-day window. So it's confirmable sales within the 90-day window. So it's based again on facts, and it's understanding that we want to ground our clients by providing them information again that's based on facts.
Right. So when I go in and do an appraisal for someone's house, I only base it on 30 days. Because in 30 days, a lot of could change. So if I told you price in February, so now this is now April 4th, that price, what I gave you then, could be different than, and most likely it is different than now, right? And even the rates, the long-term rates have come down a bit.
Absolutely.
So the short-term have not come to there yet. So, the banks are only going to give you a 90-day with an appraiser, because when you buy the house, they're going to send an appraiser to the house. You got to be qualified. And they'll look at, what things do they look at when they're doing the qualifications now? What would be the things that really stick out as a red light and a green light? So if I'm going to go to try and buy something, what would I do to try and get my credit up, and not to go buy a car or something just before? Because I see some guys do that. Oh, God.
So we think it's extremely important to understand that there's got to be some prep and pre-planning, right? Before you're ready to kind of take that step, and ensuring that you're mindful of where your credit score is sitting is that key first step. The higher the score, the better access you're going to get to the highest sort of loan qualification if you can afford it, and 2, the lowest interest rate. So we want to be mindful of our credit score. And not everybody has perfect credit, but we can work on it
Tell us about
together.
the score. Let them understand what score means.
So your score is basically will demonstrate to a lender your ability to manage credit effectively and pay off your required debt on time. So it demonstrates credit worthiness, the ability to manage debt effectively. Now, a good score or a positive score is a score of anything above 680 will give you the ability to maximize on your loan exposure, your loan qualification, what a lender is willing to extend. And 2, it will give you access to top tier interest rates, meaning the lowest interest rates on market. So a score of 680 or above. Now, there are a lot of apps out there, and most banks these days will give you a visual of what your score is as an add-on sort of service. So it is important that you're tracking that. It's also important to, again, connect with a mortgage specialist. We're here to provide you with that support and tips and tricks to improve your score. I'll share some quick ones. 1, if you do have credit that you're not using, leave it. Don't close it. The longer your history, the more it works in your favor. 2, you want to ensure that you have at least 2 active trades. What are trades? They could be a car loan, a student loan. If you have credit cards, you need to be using them. You don't want to be overusing them. So it's a delicate balance. So you want to keep utilization below 65% is my general rule of thumb. So let's just say you have $5,000 available on a credit card. You don't want that balance ever exceeding $3,500. I personally will diarize my due date in my calendar, and 5 days before I am going to pay off my balance in full. My mindset, I like to financially plan. I want to ensure anything I'm charging is helping me build credit, but I'm not spending more than I can afford to pay off. I also will encourage clients, pay a little extra, because if you pay extra, it sits in a credit balance. It's reporting and helping boost your score. So those are some tips, and we can share others, but not everybody has perfect credit. It is important to be aware of your credit score, and there are tips and tricks that you can employ to get your score where we need it to be.
So what I hear you saying is, let's say I'm 680 or above, I'm going to get privy to the best rates that are available.
Correct.
But if I'm only at 600, I'm going to pay a higher interest rate.
Correct. Absolutely.
Right?
Yeah.
So that's important you understand that, because a lot of people don't understand that. They just think the interest rates are equal across the board. But by having that score rate much higher, and I don't really like how they do the score rate all the time. I never have.
I used to have my mortgage broker license, and I was going to do real estate and mortgage, but it was a conflict, so I just gave it up. But I never really liked, because it goes, what, on a 2-year term?
Exactly. There's no logic to the credit reporting system, which is why I think it's extremely important that you work with a specialist that can give you the tips and tricks that you need to have it reflect where it needs to be as well.
So if I get looked up by Rakhee, that's one against my credit score. I go to another bank or mortgage broker, that's another knock against my credit score. Then I go to a third one and a fourth one. Each time I go to look, it decreases my credit score.
Okay.
True?
Absolutely.
Now that part I can never figure out.
But that's another advantage for working with a mortgage broker. We do one credit bull and we can shop it with multiple lenders. So we kind of take that. It's very similar to working with an insurance broker. We take on the onus of ensuring that we're securing you the best product, and we're able to kind of ensure that your credit isn't necessarily needing to be checked multiple times.
Right. So that's why having a good bank or mortgage person, well, normally the bank goes through, I won't name any brand, but if it's like a big 5 or big 6 brand, they just run it through their source. But as a mortgage broker, she'll run it through 40 different sources, and she'll go shop the best rates that some person that has the money will take that risk and give you the best rates.
Absolutely. And you want to ensure that it's not just rate.
Can we get everyone to mute?
It's so important to understand when you are securing a mortgage that you have a strategic plan. I often like to say, I'm not a mortgage broker, I'm a wealth builder. How you live your mortgage is really how you live your life. Who wants to be chained to debt for 25 or 30 years? It's important to have a strategy. And again, most buyers are looking to make a change to their mortgage, move up in 3.5 to 4 years. I know Daryl had said 5 to 6 years. My sort of strategy is every 3.5 years. You want to have flexibility within the term. You want to be aware what's the point of having a record low rate that at the time you have to make a change to that mortgage, you're hit with thousands of dollars in fees. So it's a balancing act. There's so much more to consider when securing a mortgage product. Rate's important, but there are other things to be aware of as well.
And as a mortgage broker, you give them all that guidance.
Absolutely.
Right.
We educate you. It's hard. It's important to kind of stay in your lane. You focus on what you're great at and lean on a subject matter expert that you can trust to give you the advice that you need and the guidance you need to ensure that you're securing the right sort of product for your family. This is such an important decision. Your home is usually your largest asset, and your largest debt is usually your mortgage. So you want to ensure you're feeling supported. And I believe we have a question here.
All right. So is the current market an opportunity for investors with only 20% down? It has become very difficult to make a rental property cash flow. I'm interested in your thoughts from a real estate investor mindset, please. So this is from David. So what I would say, David, is that, the one thing that has gone up dramatically is rents.
Mhm.
Rents have gone up like boom, 30%, 35%. So, because of the higher carrying costs, it covers you to buy that mortgage. But the same token is what I spoke about earlier about that principal. Your principal, unless you already own the property, but if you haven't, your principal amount, let's say it's a $600,000 condo investment, right? But maybe a year and a half ago, that condo was worth $750,000. So you've already got $150,000 knocked off your principal. So if you had 20% back at 750 and 20% at 600,
that's a lower down payment amount. That's less required upfront for you to execute on a potential purchase.
right? And then you also look at your long term. So your principal is that much lower. So even if you want to go buy a secondary property, you have more equity because you've already paid 150,000 of that 750. You look at some of the assignments today, some of them are actually selling or equal to what they bought 2 or 3 years ago.
Correct.
Right? So that you just have to have a good realtor that can educate you on what prices were or what they are and what's the projection in the future. Like I was just at a grand opening at Raglan, and they're going to be at Bathurst and St. Clair. So they were showing some of their projects that they built up over a term, and they were showing the return on investment, like unbelievable. And that's what I expressed earlier about prices in 1977, 60,000 or whatever it was. It was low. 64,000. Today your average is $1,089,000, whatever. So your equity has gone up dramatically. So that's why rents have gone up dramatically. You're getting at least 30 or 35% more than you were a year ago.
And that's where I can't necessarily agree that cash flow is an issue. I'm finding that depending on where you're looking to buy, and that's where a strategic sort of partnership with a realtor that really understands what your goals are, because there are pockets where the market rents will debt service your mortgage loan obligations on a property. We're seeing it.
Yeah, you don't want to go into an investment with a negative cash flow. You can.
You can.
I bought my condo and it probably had a negative cash flow of about $100.
But I set expectations with clients that if you are going to purchase an investment property, be prepared to put an extra 200, 250 aside for unexpected expenses. Maybe there's a short-term vacancy. It's important to plan. As an investor, there's always a cost associated with taking on a new investment. And I think we just plan for it. We budget for it. But market rents are definitely reflecting, I think, higher than they've been. And cash flow is definitely something with the right sort of strategic partnership that can be attained.
So, David, I took less money because I got AAA tenants. It's my own place. I bought it for a family member. My father passed away, so then we had to change plans. So what happened is that I had great tenants, and I could have got more money for the rent. I would have had no negative cash flow. So they were there for 5 years. And then when it popped up, then because of the newer building, I got to increase my rent level. Like it was $500. It just went in one day. I could even charge more. So if you have great tenants, you might give them a little better rate than somebody else because you have AAA tenants that you feel secure with and you don't have to worry about, but some people are just trying to get everything up top. So it's really, again, strategizing and see what's most important to you. That's the key, right? Find out what your affordability is by talking to a mortgage broker first, right? Because lots of people now can, if you got a principal resident, if you bought a property 10, 20 years ago, you have so much equity in it, you can just take an equity loan from that home and get it secured.
Correct. Absolutely. You may want to review the option of tapping into some of your equity. I believe in doing the opposite. I bought my first home in 2008 with the subprime mortgage crisis in the US and nobody else was buying, but it was my opportunity to go out there and get my dream home. So I bought my forever property because I was going to work on a strategy to be mortgage free. And then I refinanced to purchase investment properties because you always want the weight of the mortgage on the investments. It's a taxable write-off.
Yes.
So there are strategies out there for people that might want to take advantage of the current market and the dip in market value right now that we are seeing and look at it as an opportunity to sort of plan ahead to ensure that you're financially working on a strategy to building wealth as well.
So here's something I would say. Every accomplishment starts with a decision to try, right? So, you have to have a vision, you have to have a plan, and then execute. That's how life works, right? There's no secrets to success. It is the result of preparation, hard work, and learning from failure. Will you always hit a home run? Maybe not. You're going to get a few strikes. But the thing is, if you look at real estate as a longer-term investment, you'll always come out on top. So, when's a good time to buy? When's a good time to sell? When's a good time to invest? And I always say there's no better time than the present time. Because this is the time that's most important, right? Your now time. We can look back in the past and think of our mistakes that we made. I should have bought that property. I could have had that property. I could have bought that property that we can't quite see it, but the one in the big white building back there, that was Cosmo's property. They owned all that land. Now they're up on Leslie Street. They got that great big humongous. That's where this stuff came from, right? So I could have bought that. That was actually Bristol. They had the Bristol truck rent and Cosmo was there. And I could have bought that property and then they weren't sure and they weren't sure. And then I missed the opportunity. But I would have been worth so much money if I had had that money. Could have, should have, but it's a missed opportunity. So don't miss your opportunities. Just take action and do it correctly and you'll always succeed. Get a great mortgage broker. Get a great realtor that's going to help you go through. So here's a question, and we talked a little bit about this fixed rates versus variable rates. And I guess it depends on their income and depends on, their credit score, what they can achieve.
Absolutely.
So tell us about that. What's the difference that if I'm an investor, should I look at a variable rate? Should I look at a fixed rate? Then I don't have to think or worry if I take the fixed rate, but I will pay a little bit more.
Absolutely. So for investor clients, there is merit in reviewing a variable rate product because of the flexibility it offers. You can exit that mortgage contract with 3 months interest penalty. You also have the ability to refinance because as an investor, your goals are a little different. You're looking to potentially tap into that equity at the earliest opportunity. Maybe the goal is to purchase a secondary investment. So having flexibility and knowing that the interest component becomes the taxable write-off with the right sort of, support and coaching, ensuring that you have the right sort of financial team in place, the variable rate product can at times be the best solution. However, for those clients that are concerned about cash flow, a fixed rate 3-year term at let's say 4.59%, and there is a premium charge for, an investor purchase, which is kind of having that rate hover closer to that 5% mark, may give you that cash flow opportunity because now your payments may likely be covered by that rental income coming in. So again, we will construct, it's so important that you are constructing a strategy that's going to match your personal goals. But the variable rate does have merit when investors are looking to purchase property for the intention of that serving as an income source or a revenue generating source for sure.
So the bank looks at, if you're an investor, chances are you're going to have to pay a little higher than the posted rate.
Correct, because they know you're making money and they want a piece of the pie.
So they're agreed too. Right?
Absolutely.
You know, again, that's one of the things that never made sense. But I look at the other side of it is they're taking a greater risk because it's not your principal residence. So you have a greater chance of losing that if you're in trouble. So that's why they charge you a bit of
A little bit of a
premium,
premium on the
right?
rate.
It secures their money to their investors.
Correct. And
Right.
they want to ensure that you're putting at least 20% down as the down payment. Lenders are also going to be a little bit flexible as well with lending guidelines. What we're finding is that we hear a lot in the news, and when we turn on, depending on who we're listening to, that it's becoming difficult to qualify. And it absolutely is with higher rates. But lenders are also open to helping us work outside of the box. So if you have, for example, additional funds and savings, so asset fallback, meaning we can demonstrate to a lender that you have additional funds and savings. We can kind of expand that box at times, right? I was able to recently help a client that was looking at an investment, and it was a single family residential originally, and now we were able to move to a duplex. It did require a little bit of a higher loan qualification, but we were able to get the numbers to work with some additional rental income. A 2-unit property is going to yield a little bit more in rent. And we were able to work outside of the standard box and get that client qualified for that property purchase. So again, if we can demonstrate to a lender that you have a strong credit score, that we have strong sources of income, that we can secure a market rent report that shows the market rents as being healthy for a specific property, and demonstrate that our clients have a little bit of extra sort of in savings to fall back on, that positions the file for success.
So if someone had a secured low rate on a mortgage, should they stay in their current property until your term is up? Or is now time to sell and purchase your dream home? Because what is it, 60 days? So if I sold my house, right, and I have a very low rate, is it 60 days that I can port that mortgage?
So from the moment you close on your sale, you have up to 120 days
It's
to
120
go.
now.
It's 120 days. And
Whoa.
what we're doing is I'm calling all of my clients that secured a property in 2020 and 2021 and educating them on their options of porting their mortgage. In 2020 and 2021, when the market was peaking at its highest,
And rates were this.
exactly, you had to settle. My clients had a list of must-haves, and if they were able to get 50% of what they had on their sort of list, they were buying that property because it was about winning the bid. Those clients right now have a secured low rate, and those that are of the mindset that we should hold and wait, no. Market has shifted. You can take your mortgage with you and now go out and buy your long-term forever home. Go out there and ensure that you can now secure that must-have list and take that low rate with you.
You know, and that's what a lot of people don't realize, that they think once they sell their house, they have to give up that low mortgage rate. So they're sort of stuck in a pattern. But what an opportunity. You already have that low rate of a couple years back, and you can go buy now when the principal is decreased. So it's a double win for you. Like I just thought, and I only thought it was 60 days. So that is brand new that I found out just today. I was just talking to one of our agents. He sold his house and he's got the low rate, and he thought I got to buy within 60 days, right? So he's sort of like getting in a panic mode because already a month has passed by already. And he's saying, I'm getting a little like he's a typical buyer, like everybody else, right? But, I'll have this conversation with him to go back and check with his bank
Exactly.
to see exactly what your term is over that. But in the same token, I still told him that he should be racing to get a property now, because prices are probably going to inch up further as the days go, as we get more sun out there and more snow disappears. That, listen, in Canada, I can't speak for everybody else, but no matter what, in Canada, spring market is spring market. That people just, it's like a hobby that, we have open houses. I know a couple of my agents were at a place, they had 8 good buyers coming into it. I know some of the places that were downtown, they had 39 buyers going into it just this last weekend. So they're lined up. I've gone into some of the sales offices, Raglan and Union City, hundreds of agents lined up to go in and check out the project. right? Because the builders are offering some great opportunities for investors. Or Batherson St. Clair is going to be more of an end user. So, you buy in that area, because if you go to that area, it's mostly low rise and older places, some very expensive homes. But, there's going to be over $4 billion worth of investment. I mean, there's 5 to 7 great big builders that are going to be putting like 40 towers there. So it's going to change that whole demographics. So, your house value is going to go up more there. So you're thinking of buying, maybe there's a good area. So strategize where you want to go. Like I got people every day, if you see a new subway going in, chances are all the stuff around it, whether it be a condo, be a house, semi, those prices are going to go up, right? Transportation, that's key. Location, what I was taught 34 years ago, and it certainly hasn't changed today. So, having a good mortgage and having someone, listen, everybody just thinks there's one route to get a mortgage. You just go to the bank, you get shot down. But you have many different ways that you can open up different doors.
Absolutely. So we have alternative solutions. And the other benefit and sort of my superpower is breaking the box on lending guidelines, coming up with creative solutions for our clients. And having that knowledge when you're working at the bank level, and sometimes we have relationships, but you're working with a graduated teller. You're not working with somebody that really understands the language of the numbers. And I'll kind of just draw this example. When a client comes to us with a it's not just here you go, this is what you can qualify for. No. There's got to be a lot more involved. We need to know, what do we need to sell for at a minimum, right? This is information that they can go back and now say, this is our plan. This is what we're going to have available to us. This is the mortgage I'm moving over to the new property. This is the new money I'm going to need, and this is what it's going to cost me. Once you have all of the data available to you, you're now empowered. You're secure because you have that foundation. The fun part is going out and shopping for that property. When you walk away with something tangible that you and your real estate agent and your advisor can sit down and strategize around, and if we need to tweak the numbers, we can, that gives you the power to go out there and say, does it make sense for me to do this? It doesn't always make sense, but having the knowledge and information available to you allows you to make an educated decision.
Guys, it's so important to have an educated decision. That's the battle moving forward. Listen, so in Toronto, they have a double land transfer. So in the GTA outside of Toronto, it's one land transfer. So how does the banks treat that? So like I sold my client's house up here for a few $1 million. Their son lives downtown. He wants to buy a condo downtown. And, I remind him that you got a double land transfer. The place he's looking at is they're asking 1.3. So he would have 2 land transfers taxes on that. So maybe it would have cost him 30, but it's going to cost him $60,000 to add on to that 1.3. So how does the bank treat that extra, like it's an extra borrowing cost?
They don't. So one, it's important to know that your closing costs need to come from either the proceeds of sale or your own resources. They can't be borrowed. And 2, whenever your clients are walking into a bank, their strict sort of role is to provide them with an assessment of what their mortgage qualification is. Nobody breaks down the numbers. For example, on this, we highlight real estate fees, HST, land transfer tax, legal fees. This is reality of what it's going to cost to make that decision. Again, empowering your clients with knowledge and facts so that they're prepared.
So what she just told me is the bank is not giving you the mortgage on that $60,000.
No.
So that means you've got to come up out of your own pocket money. Remember, we're trying to work within 20% down deposit, right? So you've got to throw that 60,000 onto that 1.3. So now it's not only 1.3, it's 1.136, right? So they need to have 20% on that number.
On the 1.3, the 60 is just the additional funds that would be required as part of the out-of-pocket expense.
But they got to come up with that.
Correct.
Not on their mortgage.
Nope.
Right? So that you have to have that information for. That's why you need a good real estate agent and a good mortgage broker to give you everything, because nothing worse than having a hidden surprise to come out closing. And now I got to come up with another $30,000. Most people are already tapped out and they don't have that. So they're calling friends, family, whoever that they can borrow
Ooh.
to get that.
We've all
done.
had those stories, right? And we don't want
You know.
that. We work so hard to support our clients. We want to ensure that right up to the moment of closing, that it's an easy, stress-free experience. We want to take that responsibility off. We want to provide them with that support. We want them to feel empowered and prepared.
So we're coming to 9 minutes. So can you do a zoom in on our little live audience here? I want them all to say hello. Hi, guys. Hi. They're going to just zoom in on you right here, right? Everybody say hi. So I've been asked, does anyone in the live audience have a question that they would like to ask us, right? Frank.
Just to help us out here, qualifying someone without preliminary stages. I remember. I'm sorry.
Come on over here so we can see you.
Yeah.
Hi.
I just want to know if they used to tell us that the general rule of thumb as a guideline is if someone makes 100,000, they qualify roughly for about $300,000.
So 35%, right? What's
3.5
So-
more than their annual. Is that still something that we can start working with?
well, you have
So that,
two
that's
systems. Some of the
excellent.
two systems.
So that's excellent. Absolutely. The two systems are insured, meaning when their client's looking to put less than 20% as a down payment, just,
Even with 20%.
but it's different. It's a different calculation. So that's why it's a two
Yes,
method
that's
process.
why I said give them the
So-
two systems.
If the client's looking to put less than 20% down, then for quick math, it's 4.2% times the income. That's again, very round math, because if the property has any condo fees, that will reduce the overall loan exposure, right? So again, if you're looking to run some quick math and you're in an initial sort of buyer consult and you want to be able to understand what your client's purchasing power will be, 4.2 times the income is great when the client's looking to put less than 20%. Now, quick math again, if your client is looking to put 20% or more, for quick math, it's 5% of the 5 times the income, 5 times the income. However, if they're working with Mortgage Savvy, I can break the box on lending guidelines by asking additional questions. And I have been known to take it to be 6, 7 times the income, still working with our A institution, securing your clients the lowest interest rate. If it makes sense, I want to be very clear on that. If your clients can afford it, right? We don't ever want to put them in a situation where they can't, but there is flexibility when your clients have 20% or more, and you are in a situation where the bank has only qualified them for this, because the bank works in a narrow box. I mean, I'm coming from banking, right? So you populate term, then it gives you, spits out an answer. There's not a lot of like case building. On my end, I'm building a business case. I'm understanding, what does your client have as fallback? Do they have somebody living with them? You know, like additional questions that we can incorporate into an application to ensure that we're able to support that. But again, I think when you're meeting with clients, you want to have a picture. And so 4.2 times the income with less than 20% as a down payment, 5 times the income with 20% or more.
What's the total debt score? 42%?
It's actually, okay, again. So generally speaking, your debt service should not be 39,
Yeah, they dropped. It used to be
44%.
42, they dropped to 39. I didn't know. if
Yes,
they could-
and now, but I, at the same time, can take it up to 50 on both, depending on the client's
so
set of
You
circumstances.
want to advise anybody thinking about buying not to go make any type of investment before they buy, because it's going to hit your credit score and it's going to really beat you up. Like I had a guy that's looking at some property, and the guy had a truck and trailer that was 110,000 he wanted to sell it. I said, you can't buy that. I said, put it into the offer and get it onto the mortgage, right? And put it in there. But if you went and bought that property, your credit score is going to dramatically drop, right? So there's many ways to strategize. If you're going to sell your house, you need to call a good realtor. You know, we have 27 tips to prepare your house to sell, because most people, if they go buy, they say, want to go buy, but they haven't prepared their house to do the legwork to put it for sale. So if you do a number of little things on your house, you can increase the value of that house dramatically. So you need to do that preparation long before, talk to a mortgage broker long before. So if you do your footwork long before, you're fully prepared to go buy, sell, and invest. And then you know exactly where you're coming from. So we're coming down to the wire, the last 4 minutes. So I want to thank Rakhee for coming out today and giving us this valuable I think you were incredible.
Oh, thank you.
So I want to give her a big hand. Let's give her a big hand, right? So how would they reach you? Tell them how they, if they want to reach out to you and they want to get a hold of you, where they can call you, they can email you.
Absolutely. So any clients or, real estate agents that want to connect directly, I encourage you to follow us on Instagram. I really use that as a vehicle for providing education. So at Mortgage Savvy, my contact information will be available as needed. You can email me at Rakhee@msavvy.ca. You can give me a call directly, text me directly.
What's your number that they can get?
416-720-7295. Anybody in the room today will have a little booklet with our contact information as well. We're a phone call or a text message away. Anybody that's worked with me knows that I truly want to be seen as a partner, not as a referral source. And for our clients, I mean, I fell in love and I want to be your strategic advisor for life. And I want to be your financial coach. We're not transactional. These are important life decisions and you want to ensure that you have the right person in your corner. And I'm hoping I can be somebody that can provide that support.
Well, I want to thank you. You're absolutely great.
Thank
It's
you.
so great to have our first live podcast
Absolutely
with you.
exciting.
Right? So, she's one of our partners and I'll always recommend her. I'll have her involved in a lot of things that we're doing moving forward. Myself, it's the Daryl King team here. We're right here live in Richmond Hill, our first live podcast. We're going to be doing this every 2 weeks, maybe 3 at max. I've got a lot of great speakers that want to come on. If you want to come on and be one of my guests, reach out to us. You want to share something, we'd be happy to have you. If you want to reach any of my team members, you can reach us at 905-907-5464. Our home's at darylking.com. We have 34 different nationalities. We'd be happy to answer any questions or concerns or help you doing your investing. I can get Rakhee to help you set up with your where you can pick up for financing. But it's been an extreme pleasure. This is our first time doing it live, and I love it. How'd you guys like it?
That's great.
I want to say hasta la vista to everybody. Till next time, be safe, be well. Any questions, feel free to ask us. Take care. Bye-bye.